Lately, there's been a lot of time and effort put into people talking about becoming a millionaire and the secrets of millionaires and how you can save with your 401k, and that's going to allow you to get $1 million. And I want to take a moment just to kind of break down the math that goes behind this because I think that for most people in most cities, $1 million might not go as far as you think. This isn't to say that it's not a lot of money, but I think that we need to be realistic when we look at how much money we're going to need for retirement and what city you're going to live in and what you're going to need to retire comfortably when that time comes. All right, so let's take a look at each column and try to understand what the Excel spreadsheet stands for. When we're looking at the sheet, the first column is going to be all the way here on the left, and that's going to be the year. The year is going to be whatever year you are after the first inception date to which you have $1 million. Your capital is $1 million, that stays the same. We're going to assume that you get 7% in interest on your investments. A blended average, we'll assume it's a little bit of a stock and bond portfolio, and I think that's like a pretty reasonable rate. Historically, a little bit lower than the stock market, but you'd probably want to mix so you're not going to have any downside volatility. And we're going to assume that your after-tax rate is 5%. So you're able to take out 5% every year. So if you have $1 million under management, you're going to have the ability to take out $50,000 a year, which might sound like it's good. It might be enough for retirement or it might not. But here's where things get really interesting. And this is the part that you need to realize, and it's incredibly important whenever you're planning for retirement or whenever you're hearing a number like having $1 million or being a millionaire. When you come through after the inflation rate, you're going to see that we're putting the inflation rate at 6%. 6% is to represent what a blended average across the United States might be. This isn't representing the Consumer Product Good Index because that excludes a lot of things that are needed in life. So this is going to exclude your health insurance and healthcare costs. It's also going to exclude things like the cost of your home, the cost of education, and the Consumer Product Good Index is designed to be a little bit lower, and it's measuring things that don't inflate at a high rate, but daily living expenses are going to be a little bit higher than that. So we're going to assume 6%. Here's the rub, and here's where things get really interesting, and you want to be really thoughtful. In the first year, assuming you take all $50,000 out every year, you're going to end up with $50,000 in actual buying power. What does actual buying power mean? Actual buying power is defined in a way that would say what you could actually purchase with the amount of money, not just the number, not $1 million, not $500,000, but if you could purchase 10 hamburgers today in 10 years from now, and you can only purchase 7 hamburgers, that's the buying power. So when I relate to the buying power, that's how much money in today's dollars you would have in buying power. So after 10 years, you're going to see that your buying power gets cut down from $50,000 a year in year one to you're looking at something in the neighborhood of about $29,000 a year. So every 10 years at a 6% inflation rate, the buying power of your money gets cut in half. This is why oftentimes $1 million today isn't going to be as good as $1 million in 10 years. And people are going to say, well, there's the Consumer Product Good Index, and if you just look at that, inflation rates are 2, 3, 4%. But realistically, this is really going to depend on the basket of goods that you want to acquire for your lifestyle. So then we need to look at what this means. There's really two options. Depending on if you're comfortable with having $30,000 a year as your retirement income, you have to evaluate, you either need to get a higher ROI on your capital, meaning you need to do more risk-seeking behavior to get something in the neighborhood of 10, 12% to combat the inflation rate, or you're going to need to save more money. This is why we always want to look at what money we're really going to need. And I think that we want to avoid kind of the illusion of the idea that being a millionaire is enough to satisfy you for the rest of your life. Being a millionaire in the 1950s certainly was, but as time's gone by, you get a little bit of your money eroding away every year with the inflation rates. So just taking a look at this, it doesn't mean that you can't retire off of $1 million, but realize that $1 million today won't be the same as $1 million in 10 years. And when you're looking at the inflation rates, try to understand what the actual inflation rate is for the products that you want, meaning the cars or the houses or the lifestyle that you want, and look at how much that has gone up over the past 10-year period. If you want to send your kids to college, for example, or you want to pay off your kids' college tuition or your grandchildren's tuition. You can take a look at how much prices have gone up in schools, because that's not part of the Consumer Product Good Index. So when you start to wrap all these things together, you're going to see that inflation is a little bit higher than you think, and that $1 million may not go quite as far as you might hope it would. This isn't a bad thing. It's just something for you to realize, to be honest with yourself, so that when you're setting goals, you set really big goals. And then when you achieve those goals, you also achieve the things in life that you hope to achieve.